folks, we're going to talk about a bond and its valuation, and in this chapter we'll talk about key features in the bond, but at the same time we are going to talk about bond valuation, measuring yield and assessing the risk. And what is a bond? It's a long-term debt instrument in which a borrower agrees to make payments, and these payments are fixed ahead of time. That's why they are also known as fixed income security. Okay, and then usually the par value is known as $1,000. If it is not mentioned, you can always assume it's $1,000. Coupon interest rate is the one that the issuer pays to the investor, and then you turn it into dollar payment by interest rate and the par value. So you multiply the par value with the interest rate, and maturity date is when they will be paid off. Issuing date is the one when it was issued, and yield to maturity is rate of return. Not only rate of return, it is the total rate of return. That means it has got two elements in it. We'll talk about that. And so yield to maturity makes that amount. Convertible bond, that means bond can be changed into equity, and warrant is a long-term option to buy a stated number of shares of common stock. So if a bond comes with warrant, that means there is an option to buy, that means call option, certain number of stated number of common stock. Putable bond allows the holder to sell the bond back to the company prior to maturity. When you buy the bond and you want to ensure that it doesn't go down below a certain price, then you buy the putable bond. Income bond is pays interest only, and then index bond is indexed to the base rate of inflation. So there is a call provision, and that means, let's say IBM issues a bond, and they do not like the interest rate that they have to pay to the investor, yet they say, well, let's make it callable bond. When they say let's make it callable bond, it means that, well, if the interest rate falls and IBM can refinance it, it can call the bond, pay that off, and then issue another bond with lower interest rate. So that's callable bond. So for if you are an investor, you will buy the callable bond only if the interest rate promised is higher. So because they have that risk of call. And sinking fund is some allocated amount, and that to pay off the loan. And so we then talk about the bond. Here is the bond going to N, and we say, as we say, time value of money. You can use that time value of money, but interest rate has interest opportunity cost of capital, but it has got inflation premium, market risk premium, default risk premium, liquidity premium. And then we talk about how do you do this. This is the way. No, you do it. This is one way, but the best way is TVM method. And the TVM method is a 10-year bond, 10% interest rate, payment is 100 and future value is 1,000. And then you get to the present value, and then the amount is this. Now notice here that without solving this problem, you could have told that value of the bond is 1,000. The reason is the interest rate, this is the interest rate, total rate of return, is equal to the coupon yield in here, that it is paying you $100 coupon, and $100 divided by par, which is 1000, is 10%. So whenever the coupon yield is greater than YTM, then you say bond sells at premium. And in this case, coupon yield is equal to so it is interest. It should be coupon yield is equal to YTM. In this case, YTM bond is selling at par. So you can, without solving this, you could say this is the par value. Now we go to the another one, and here the coupon is 130. So 130, that means 13% is a coupon yield, and the previous bond yield to maturity is 10. So 10 is less than 13. So here is the thing that you have to do. That is, whenever you have this coupon yield is greater than yield to maturity, bond will be selling at premium, and you can see that it is at premium, more than 1000. And then on the other hand, this is the other one, the bond is selling coupon yield in this case is 7%, is less than yield to maturity, therefore bond will be selling at discount. Now you see bond travels, if it is a par bond, or if it is a premium bond, if it is a discount bond, then it travels slowly, and the coupon, this one has 13% coupon, 10% and 7% coupon, but they all travel like this. So if you buy a premium bond, you know at maturity it will be 1000. If you buy a par bond, it will remain so at par. And then if it is a discount bond, slowly it will reach the par value. So that's the convergence. And then we say at maturity, everything is value of the bond must equal par value. So now we focus on yield to maturity. So on your exam, you will have to find the value of the bond, and then you have to also find out the yield to maturity. To do that, you can follow this fundamental method, or you can do here. That means you put the N, you put the present value, payment, and then future value is the par value. So you compute I, and this is 10.91. So now with that, we look at solving for I will give you, and that. So once you know that this is the premium bond, then you know that coupon yield is greater than yield to maturity. So the coupon yield was 9%. So your YTM is less than 9%, which is 708. So this is what you have. And then I told you that, well, our YTM is total return. So in total return, there is a current yield, which is, please memorize this, annual coupon by current price, and capital gains is change in price by beginning price. So once you add, you get the YTM, and you can see that the current yield of this is 90 over price, not par, 90 over price, which is 10.15, and then you add current gain would be, this is the equation, you see, total rate of return is 10.91 minus 10.15 is 0.76 is the capital gains yield. And then you have one thing I wanted to show you is this. price risk. As the interest rate goes up, price of the bond goes down. So this inverse relationship, keep that always in your mind. Inverse relationship between price and interest. So 10-year bond is going to have this. As the interest rate goes up, it falls faster. 1-year bond, you see, impact is not that great. So this is the price risk has got higher the bond maturity, higher is the price risk. So what is the reinvestment rate risk? Let's say there is an example here. We say that you would like to invest in a bond. It's a 10-year bond or a series of 10 1-year bonds. So you can buy a 10-year bond and that's it. And the other thing is this, you'll invest for next 10 years but in 1-year bond. So 1-year bond you buy, and when it matures you buy it again, 10 times. Now what if that you after 1 year you receive 50,000 in income and have 500,000 to reinvest? So if 1-year rate falls now to 3%, your annual income would fall to 15,000. So reinvestment risk is there for those people who would like to buy short 10-year bond and then reinvest. So this is the case of pension fund. Pension fund invest in long-term bonds and sometimes short-term bonds. When they do the short-term bonds, then they have reinvestment rate risk. So this is the short-term and high coupon bonds. Price risk is low but high reinvestment risk, and on the other hand it's opposite for the long-term bond. So semi-annual bonds, you remember in chapter 5 we say that multiply years by 2 and the number of periods by 2. So and then divide nominal rate by 2 and divide annual coupon by 2. So once you do that, so your N changes to twice N, your I changes to this, and your payment changes to coupon by 2. So with that you have these numbers. So N is now 20, I is 6.5, and payment is 50, and you get the present value. And then effective nominal rate is nominal rate versus the effective rate. Your M is going to determine, for semi-annual it is equal to 2. And so semi-annual bond has a 10.25 effective rate. We just found, you put this there and you found out the value. And there is yield to call. Let's say the bond's yield to maturity is 8%, and you need to solve for the YTC. So yield to call, solving for YTM except the time to call, is used for N, and the call premium is FV. So it is an 8 years, and then you have the present value which has been solved earlier. Payments are 50, and so here is the thing, 10%. When they say it's a 10% semi-annual coupon bond, you know it is 10% of the par, which is 1,000, and the selling price of the bond is now this, and can be called in 4 years. So after 4 years, you see it will be future value will be 1050. What is it? It will call. So N is 4 years, therefore it should be 8, and present value is 1135.90. Payment is 50 because it's 10%. So 10% is always about the coupon. So bond is always quoted like 10%, 7%, you know, those are not YTM, those are coupon yield. And then payment, and then future value is 1050. With that, you have this 3.568. However, that has to be multiplied by 2 to give the annual version. So you see, so this is periodic rate, the answer from calculator. And so we have 7.137 is the annual rate. So effective yield to call will be 7.26 because you do the same thing as you did before, to the power 2 minus 1. So your yield to maturity, if you could hold to maturity, it would be higher, is 8%. But your yield to call is 7.26% or 7.137%. All right? So would you be more likely to earn the YTM or YTC if you bought these callable bonds? So this is one bond, this is another, and so forth. So your coupon rate is 10%. Your yield to call is 7.137. The firm could raise money by selling new bonds at 7.137%. Then could replace the bonds paying $100 per year with bonds paying only $71.37. And investors should expect a call because YTC is 7.37 and YTM is 8%. If they do not call, they will pay 8%, and if they call, they will pay 7.137%. So when is call more likely? If a bond sells at a premium, then coupon is, as you know, greater than yield to maturity, and call is more likely. So expect to earn YTC on premium bonds and YTM on par or discount bond. Then there is a default risk, and that also influences the issuer's financial strength and terms of bond contract. And these are the ways that investment grades are up to here. For Moody's, one company, and then S&P, BBB. These are all investment grade, and junk bonds are rest. So if you have default risk, this has got default risk, therefore they will have to pay you higher rate of return. And then there are other things that affect the default risk and bond ratings. Debt ratio is 1 time, interest earned, we have gone through them, and current ratio, and what kind of debt you have secured versus subordinated, and so forth. So unsecured debt will have higher YTM, and subordinated debt is also, because subordinated debt means you are not going to get any money unless the others are paid. So, and there are qualitative factors: earnings stability, regulatory environment, pension liabilities. So, you know, state government can also go bankrupt because they offer bonds called munis, and Pennsylvania went bankrupt at some point. Illinois close to bankruptcy. So you see that those also affect the default risk. Pension liabilities, they do not have a funded pension. They do not have money in the pension for the employees who are retiring. And ultimately a company can go bankrupt. We call that Chapter 11. And so it is that concept that is worth more alive than dead. So, and if the judge thinks that no, they cannot do it, therefore they go to Chapter 7, which is clean bankruptcy. All right? Chapter 11 stops the creditors. So hope it is clear to you. If not, please make sure